The public believes that Ryan Reynolds' wealth comes from massive studio salaries for starring in blockbusters like Deadpool, but the math reveals a completely different reality. He operates like a private equity algorithm, acquiring ownership in boring assets and weaponizing his massive global audience to force corporate buyouts. How does a standard Hollywood employee build a corporate pipeline worth more than the entire lifetime box office of his biggest film, without spending a single cent on traditional advertising? The average Hollywood operator is strictly an employee. They rent their physical labor for upfront cash. If they hold incredible leverage, they might negotiate a minor percentage of gross box office profits, the total ticket sales before expenses. They remain fundamentally tethered to a massive studio conglomerate. When celebrities engage with consumer brands, they sign standard endorsement contracts. They trade their famous face for a flat fee. This model captures absolutely zero enterprise value, the true total worth of a company. The talent gets paid once. The corporation keeps the underlying asset forever. The true net worth of Ryan Reynolds was not built on movie sets. In 2018, he abandoned the traditional employee contract entirely. He gambled on an ownership stake in a premium gin brand. This was a highly saturated consumer packaged goods market. The failure rate here is catastrophic. He risked upfront cash for back-end equity, a percentage of future profits. He placed a massive bet that his reach could move product faster than a traditional marketing agency. Traditional celebrities are terrified of this risk. They prefer the safety of a guaranteed paycheck. But a guaranteed paycheck has a mathematical ceiling, whereas equity has unlimited upside potential. He proved his audience could directly drive consumer sales. He eliminated the corporate middleman entirely. His primary production infrastructure functions exclusively to manufacture marketing inventory at exact cost. He bypasses traditional advertising networks entirely. He owns the commercial facility. He owns the global distribution channel. He built an in-house agency operating with zero friction. Selling premium lifestyle products is easy for a wealthy celebrity. The true test of this financial architecture was proving the model was completely sector agnostic. Could he take this exact framework and sell something entirely boring? He pivoted away from premium liquor directly into a budget utility. He acquired a 25% stake in a discount wireless carrier. This is a low-margin, high-churn industry. Massive telecommunications monopolies dominate the space. Here, the underlying math becomes incredibly aggressive. He deployed his personal distribution channel to eliminate customer acquisition costs, the price to buy a new user. He reduced marketing spend to absolute zero. Telecom infrastructure is incredibly expensive to maintain. The only way for these budget carriers to survive is to acquire customers cheaper than the major monopolies. By eliminating the marketing budget, he gave the company an unfair competitive advantage. The corporate valuation exploded because the profit margins were entirely protected from advertising costs. Acquiring a new telecom subscriber usually costs hundreds of dollars in targeted digital advertising. He simply turned on his camera. He spoke directly to his millions of followers online. When a company eliminates marketing spend, profit margins explode overnight. Consequently, the enterprise valuation multiplies exponentially. He forced a massive corporate buyout, $1.35 billion within just 4 years of his initial entry. To put that into perspective, that single utility flip generated more liquid capital than a decade of starring in global blockbuster franchises. He controls the distribution engine. He rents absolutely nothing from traditional media gatekeepers. He is the platform. This mechanical reality forces a critical debate about the modern digital economy. Is leveraging a massive fan base as a free marketing engine for corporate buyouts a brilliant structural evolution of fame, or an exploitative monetization of parasocial trust? The system was mathematically flawless. It generated massive paper wealth through high-margin tech and telecommunications exits. Then, he made an asymmetric bet, a risk with wildly uneven downsides. He completely defied his own established logic. He diverted critical liquid capital away from corporate acquisitions. He purchased a distressed international professional football club. He tied substantial liquid cash to the unpredictable outcomes of a lower-tier sports league. He risked his carefully curated global brand reputation. This represents a brutal transition away from clean corporate flips. Professional sports franchises are highly capital-intensive machines. They systematically destroy cash flow. When a technology company loses money, it is usually to acquire new users. When a sports team loses money, that cash is simply gone forever. Player contracts are completely guaranteed, and stadium maintenance never stops. This creates a toxic loop of endless capital requirements. They require constant, multi-million-dollar operational loan injections. This sustains league promotion, covers exorbitant player salaries, and funds stadium upgrades. The emotional public narrative focuses entirely on the underdog sports victory. The forensic balance sheet shows a continuous cash drain that hemorrhages red ink every single quarter. Financial media consistently reports gross revenue as hard cash sitting in a personal checking account. Gross does not equal net. Apply strict institutional reality to his entire portfolio. A massive 40% blended tax discount vaporizes a huge portion of those corporate payouts immediately. Add a 10% operational overhead just to keep his massive production infrastructure running. The actual realized liquid capital shrinks drastically. Furthermore, a severe liquidity bottleneck, a trap where assets cannot become cash, operates just beneath the massive paper valuation. This means his wealth is tied up in assets, not cash. Hundreds of millions of dollars from those massive conglomerate buyouts are functionally trapped. They are locked up in restricted corporate stock, shares that cannot be sold immediately. He cannot simply sell those shares on a whim. Doing so triggers market panic or violates strict legal lockup periods. He does not sell his time for money. He uses his own distribution to multiply the valuation of assets he controls. But this entire financial architecture rests on a single, highly fragile point of failure. The model requires extreme, key person risk, a reliance on one irreplaceable human. The entire corporate pipeline relies on one individual. He must remain culturally relevant. He must remain universally liked by the mainstream public. What happens to the billion-dollar machine when the public finally fatigues of the joke, and the free marketing engine instantly stalls? This brings us directly back to the central mystery. He built a massive corporate pipeline without spending a single cent on traditional advertising. He internalized the marketing agency. He weaponized his own fame to act as the ultimate frictionless sales funnel, but the public perception of his infinite wealth is vastly overstated. Breathless media headlines completely ignore the underlying liabilities. Stripping away the $350 million public claim reveals a much sharper clinical truth. We estimate his actual realized liquid capital at a heavily discounted $200 million. The vast majority of his wealth remains completely illiquid. It is permanently tied up in restricted corporate equity and capital-heavy sports franchises. That $200 million is enough to buy 4 private jets in cash, but it is a fraction of the billionaire status the media blindly assigns him. The timeless financial principle demonstrated here is absolute. True wealth is never generated by trading your time for a simple salary. It is generated entirely by capturing equity and controlling the fundamental cost of distribution. To the members of the Capital Logic Network who support our channel and make this possible, thank you for everything.